The PGM market remains in a state of flux. Despite robust fundamentals and a forecast deficit of over 1 million ounces, the perception of the PGM space is sometimes less bullish than high-profile commodities with a direct link to the clean energy transition. But those perceptions are juxtaposed against an increasing range of use cases for PGMs, led by increasing prevalence of hybrid vehicles as part of the global decarbonisation push. Something just doesn't add up. The World Platinum Investment Council has forecast a deficit of over 1 million ounces for palladium this year, and Director of Research Ed Sterck has told InvestorStream that while a significant deficit is likely to continue into next year for platinum as well, these underlying deficits were not being recognised by the market right now in terms of pricing.
Actually, we've seen the pace of battery electrification has slowed significantly. We've seen substitution of platinum into petrol vehicles, and actually for this year, automotive demand for platinum is expected to be at a 7-year high. We're also seeing extremely strong demand for palladium, but yet the market isn't recognising these factors. So what we think is likely to happen is, as time goes on, we expect the deficits to deplete above ground stocks, want the market to tighten, for those underlying fundamentals to become the most important mechanism for establishing value once again. And that's the point really at which we'd expect pricing to reflect underlying fundamentals and the conditions to begin to align to allow for the development of new mines.
Back in 2010, underlying fundamentals were the main price-setting factor for platinum, but according to Sterck, things have since changed in the market.
Firstly, we saw the steady decline of light-duty passenger diesel vehicles in Europe, accelerated by Dieselgate in 2015. You then had the rise of battery electrification, and so in the minds of the market participants, the view has been that with the rise of battery electrification and the decline of diesel, the most important end market for platinum and palladium was going to gradually evaporate over time, and so that has created a fairly unattractive outlook for the metals.
The current state of flux has put the world's largest PGM producers, many of whom are located in South Africa's Bushveld complex, which accounts for 70% of global supply, in a bit of a catch-22 that will be familiar to most resources investors. Firstly, mining companies tighten the purse strings on capital investment as market prices soften. But when the demand cycle turns, it puts them behind the curve on bringing new supply to market, as Sterck explains.
And the challenge is for a producer, particularly with regards to platinum, where you've got deficits for the foreseeable future, we know that new supply is going to be needed, but to make an investment decision now when market prices aren't supportive of project economics right now, but you've got a very long lead time to developing new operations, that creates a very challenging quandary in terms of attracting capital and building new operations for the time when that new supply is going to be needed. So getting the timing right is the challenge. Now, we've done a lot of work on pricing recently, specific to platinum more so than palladium, and effectively we've got a big report coming out on this in the next few weeks.
As investors weigh the outlook, emerging PGM producer Southern Palladium continues to advance its flagship Bengwenyama Project in the Bushveld. With a pre-feasibility study on schedule for completion in December, Southern Palladium recently flagged a mineral resource upgrade, which included a measured resource of over 2 million ounces, 7E PGM, for the UG2 reef. That included final results from a comprehensive 2-year drill program that commenced in 2022. Further confirming the project's emerging Tier 1 status, Southern Palladium also announced a 35% increase in the overall mineral resource at Bengwenyama to 35 million ounces. With shallow mineralisation at Bengwenyama that's consistent with the other Bushveld producers, analysts anticipate low per unit production costs to extract high PGM grades once the project moves to development. The numbers for Bengwenyama look good, so the question for investors is, can emerging Tier 1 producers cut through the noise in the current market environment and unlock value for investors? A critical indicator that PGM investors look for is inventory levels being held above ground. And while inventory levels are somewhat higher, market sentiments play a huge role in how freely available those inventories are.
So even when palladium prices back in 2016 began their long run up to over $3,000 an ounce, inventory levels were much higher than where they sit today. So it comes down more to sort of sentiment and market expectations as to how freely available those inventories are. For platinum, we see those inventories declining rapidly. At some point that should be reflected in the platinum price. For palladium, it's a little bit more of a nuanced picture. Inventories at the moment are being drawn down upon pretty quickly right now, but the general consensus view is that palladium goes into a surplus at some point in 2026, 2027.
With the release of the World Platinum Investment Council's latest Platinum Quarterly, Sterck said many of the key catalysts point to a tightening PGM market, and market dynamics can change quickly.
Look, I think it's ultimately things that indicate that the market is beginning to tighten. So it's the forward curves beginning to flatten, perhaps heading towards backwardation. It's lease rates beginning to tick higher. And those are all indicators that, there's genuine tightness coming through in the market and, in theory, are precursors to prices potentially moving higher. The one challenge with that is that these things can change very quickly, almost overnight. So there won't be a particularly large amount of warning. Things can change quite rapidly, as I said. But fundamentally, we're in an unsustainable situation. Commodity markets can exist for fairly extended periods of time in supply-demand deficits with above-ground stocks continuing to fill those deficits. But at some point, the value expectations of the holders of the residual stocks gradually increase. And so you begin to see that reflects in pricing, and in theory, pricing should move higher to either price out demand or attract new supply into the market. In PGMs, both demand and supply are pretty price inelastic, and so that should play out into value expectations in the future as well.